Good morning, everyone.
Morning,
Morning, Ron.
Kath. Morning.
And who
Hi,
is
Mike.
this now? Hi, Michael.
Well, we have a special guest with us today. And it's,
Good afternoon, everybody.
hey, it's afternoon by you and morning by us. So anyway, I'm sure everybody's got their mailbox filled and their cell phones filled with people speculating about the election and what's going to happen. So if you're listening to this, thank you. We're going to do some of the same, but we have an expert. Mike Halloran is a 20 years experience in financial research. He's with Janney Montgomery Scott. He's a chartered financial analyst, smart guy with 3 degrees. He has an MBA from Carnegie Mellon and 2 engineering degrees from University of Florida and University of Pittsburgh. And Mike has agreed to educate us on what the differences are between Trump and Biden and what we should be ready for. So we're all sitting here waiting for the outcome. But while we're doing that, we should maybe start to think about how we should react depending on the outcome. And it might be a while before we know, but I think many of us are thinking we can know as early as tomorrow. So, Mike, I'm going to turn it over to you and educate us, please.
Thank you, Ron. Well, the first thing I'd like to say is that we think people should maintain their investments regardless of the election outcome. We think that the economy is on a path to a sustainable recovery. And so under Trump, we've had taxes cut, so corporate taxes and individual taxes were cut, and he did a lot of deregulation. So that would continue under Trump, and that was generally favorable for the economy and markets. Under Biden, you would see additional fiscal spending, and the taxes that while he's proposing taxes that would go up, that would probably be delayed, and so we wouldn't think that would happen right away. We think that the stimulus would be front loaded. And then he also has a lot of spending that he wants to do on green energy initiatives and to address climate change and infrastructure. And so all the fiscal spending that Biden would want to do would benefit economic growth in the economy. And so that would overcome some of the higher taxes that corporate America would face. So either way, we think that we're in good shape, and the potential for lower trade tensions on a global basis. So President Trump pursued higher tariffs on a lot of our trading partners. That created some uncertainty on a global trade front. Corporate America doesn't like uncertainty. And so we think that you would have reduced trade tensions under a Biden presidency. And so between the increased fiscal spending, reduced trade tensions, we think that those would offset the higher corporate taxes so that you would still have a favorable investment environment regardless of who wins the election.
Good. Not to worry. That's good.
Okay, now at any time you want me to show the PDF on the difference between Biden and Trump, do you want me to show that right now?
If you want, we can walk through some of the major differences.
Okay.
Yeah. Isn't the case some sectors of the economy will do better than others depending on the Biden or Trump?
Yes. So President Trump, his signature legislative achievement was reducing corporate taxes from 35% to 21%. And that really went a long way towards making us competitive on a global basis. If you look around the world, at 35%, we stood out like a sore thumb relative to everybody else. And so capital goes to where it's treated best, and those high corporate taxes, if you could do business internationally, you were doing it. So a lot of these multinational companies that had the majority of their business internationally, they were setting up in places like Ireland and other locations where the corporate tax rate was very low and favorable for them. And so we think under Trump, you would continue to see that 21% tax rate. Biden, he's proposing to raise the corporate tax rate up to 28% from 21%. So he's looking to reverse about half of Trump's tax cuts. And then he would also raise taxes on foreign income. And so a lot of these companies that I mentioned, some of these multinationals, international companies, mainly the technology and pharmaceuticals, he would try to raise their tax rate on their foreign income. And so we think that there could be a little bit of pressure under some of these healthcare names and technology names if you did see a sweep. And I should mention that it's really important to gain control of the Senate for Biden. So in order to pass these major legislative initiatives, he needs control of the Senate. So if you look at whenever Trump was able to reduce the corporate tax rate from 35 to 21, the Republicans control both the House of Representatives and the Senate, and that was critical for him to get that program through. And so for Biden, he needs a clean sweep. So you're hearing a lot of talk about a blue wave.
Right.
And so in order to have a blue wave, that would be for the Democrats to control both the House of Representatives, which they do right now, and then on top of that, controlling the Senate. And so that's really what's going to be key for these markets is gaining control of the Senate for the Democrats, and then to the extent at which they get control of that Senate. So if right now the highest probability is on the Democrats just getting marginal control of the Senate, and if that's the case, you probably would they would have to compromise a little bit. So the Democrats would have to do more compromising relative to their major initiatives right now. If they get a strong majority in the Senate, they won't have to compromise as much, and so you could see you would definitely see that tax rate go to the 28 versus maybe it only goes to 25% if they only have one or two extra Senate seats. If they only have like a 51, 52 seat lead in the Senate. And so that's really critical, that control of the Senate for this. And so Biden, he's also looking at raising the capital gains and qualified dividends tax rate up to 39.6% for those earning more than $1 million. And so Trump, he would keep the capital gains rate at 20%. And so taxes both on corporations and individuals would go up under Biden. And so that on the personal side, so the cap gains and qualified dividends going up for people making more than $1 million. That cohort, their marginal spending that occurs up at that level, it isn't really that critical. So we don't really think that would have too much of an impact on the economy. It would really just be the corporate tax rate going from 21 to 28 that would be a big driver there.
Is there any interest in closing loopholes that people, corporations, and so on use to reduce their tax bills? So that the rates will change, but how about the use of shelters?
Yeah, that could have some impact on some of these MLPs and partnerships. So that's always a concern. The real concern would be taxing the foreign profits of the technology and pharmaceuticals, because they're big parts of the economy. Technology makes up on the order of 29% of the overall S&P 500, and your pharmaceuticals are close to, between the pharmaceuticals and biotech, you're looking at half of the healthcare sector, which is on the order of north of 10% of the overall S&P 500. And so to the extent that you're going after their foreign profitability, that's a big driver on the outlook for those stocks.
Gotcha. Okay.
And then, if you work down the list, if you go to energy, Biden has made climate change a major theme. And so if the Democrats sweep, and again, the more Senate seats that they would win by, the more likely you are to see more of their extreme policies on climate change. And so subsidies for electric vehicles, solar and wind are likely to go up substantially. And under Trump, traditional oil and gas have been a major beneficiary of his energy policies. So deregulation and opening up drilling areas for the traditional oil and gas industry and for the fracking industry, that's been a big, the traditional oil and gas have been big beneficiaries of that. And so right now, you look at these stocks and they're telling you that if you look at the solar ETF TAN, that's really telling you that these alternative energies are going to be winners of this election. I mean, that ETF was trading at about $40 before the pandemic. In March, it got cut in half, and then this summer it rallied up to 55, and after the first debate, it did a beeline up to $75 a share. And so that's like the betting markets right now. They're telling you that Biden is the favorite.
Sure.
Solar ETFs are telling you something similar. And the traditional oil and gas industry, there's a lot of overcapacity right now on a global basis. So the pandemic really crushed demand for oil and gas. People driving a lot less. And so they had a lot of spare capacity. So demand got hurt, and you had a lot of spare capacity in the system. So traditional oil and gas was in a bad place to begin with. And to the extent that you would see some of these climate change initiatives get put into place, they'd be under even more pressure. So that's a real key place for this election.
So are we energy independent now? We don't rely on foreign oil to run our economy. Is that a fair statement?
Yes, we're net energy independent. So it's a global supply chain.
Uh-huh.
So net when you net out how much we're actually exporting natural gas these days and refined products.
Good.
But yes, we've gone a long way towards energy independence, and that's been a major part of this economy. If you'd asked me 10 years ago that we would be energy independent in
Yeah.
2020, I wouldn't have taken that bet. And
Sure.
so it's been really impressive to see what good old American ingenuity can do with this with opening up these. You gave them a high price point in terms of oil and gas prices back in the that 2006 timeframe, 2006, 2007. You gave them $100 oil, and under that
Yeah.
umbrella, you could get a lot of development done. And boy, they really
Sure.
did it.
Now, what happens if fracking is closed down? Like, is Biden really serious about closing it down, and if he does, are we still energy independent?
Yeah, that's a key question. I live in Pennsylvania, and we're basically the Saudi Arabia of natural gas.
Yeah.
And so when he's campaigning here, he's telling you that he's not going to end fracking. So what they're being told, what other people are being told. So it depends on who you want to believe on all that. And then I think a big part of it is who would be put into some of these positions within his cabinets. So some of these secretary positions.
Sure.
That would be key. And what can take place on the regulatory front. They can do an awful lot on the regulatory front. So I think part of it's going to be what kind of control that they get on the Senate. But there's a lot of wealth in this country tied to it. So an outright banning of it, I don't see that taking place.
Yeah. Okay. Makes sense. I agree. It'd be a big political mistake.
Yeah. But if you just want to work down the list, so infrastructure, they're both big proponents of infrastructure. Ever since Trump made his run for presidency back in 2016, he had $1 trillion infrastructure plan that he wanted to pursue. He hasn't been able to do that yet. Biden, he would spend even more on infrastructure. And so the big beneficiaries there would be the climate change. So he would do a lot on the infrastructure to address climate change. And so alternative energy would be a big winner there. They both want to see funding for advanced communication systems. So I'm sure everybody's seeing the ads that are out there right now on 5G. So all the major telecom carriers, they're upgrading their networks to what's known as 5G. And I just wrote a special report on this. So that's something that'll be it's evolutionary, not revolutionary, is how I put it in my piece. So you hear a lot of hype about it right now. But unless you're in certain locations in certain big cities right now where they rolled it out, it's not ubiquitous yet. But there are beneficiaries of that technology. A lot of these tech names. So the semiconductors are in all parts of the communication chain. The pandemic did a lot to accelerate a lot of these advances that we were making in communications. And so these 5G networks, that's another way to accelerate these advanced networks. And so your software companies are big beneficiaries in the semiconductors. So autonomous vehicles and remote surgery and things like that, semiconductors are used throughout that entire chain. And so factory automation and the way they're going to be tied to the internet going forward. And even we just talked a little bit about fracking, monitoring and doing drilling on a well, controlling that whole process. That's all going to take advantage of 5G technology.
Yeah, that's amazing. Yeah, it'll be everywhere.
Yeah, so it's really impressive what's taking place with all that. And so semiconductors are big winners in all of that. And this pandemic, as I mentioned, pulled forward a lot of this. So a lot of this movement to the cloud that's taking place. You're seeing these semiconductor stocks really benefit from a lot of that.
So, Mike, you have a question here go ahead, Kath.
Right. I was going to say we have a comment here from Carrie says PA that Pennsylvania needs a severance tax to be really like Saudi Arabia, individual winners and statewide losers. Is that a fact? Is that a question?
Any
What's your
thoughts on that?
comments on this, guys?
Yeah, there's a big debate. So the drillers themselves, they don't want any kind of additional taxes on their operations. I don't have a strong opinion one way or the other, because I think that these guys early on, you didn't want to do anything like that because of you wanted to let these guys build out their operations and develop their processes and their efficiencies and their productivity. You've seen a lot of that. So would the system be able to withhold some additional taxes? Probably. To what extent, I don't really have a strong opinion on that.
Good, thank you. Hi, Carrie. Thanks for joining.
We want to continue on with the infrastructure here, or are we going to go down a little bit?
Yeah, sure. So some other winners in infrastructure would be just your traditional engineering construction firms, and you're seeing a lot of those stocks act favorably these days. Ever since the pandemic, there's been a push for it in a lot of corners, and I actually wrote a special piece on it. But so your traditional engineering construction firms, your material firms, some of the industrial stocks, and a lot of those names have been acting well. So there's I think you can still own those too, because ever since we've opened up the economy from the lockdowns back in the spring, you've seen manufacturing indicators act favorably, and the global backdrop, the data coming out of China is very strong. And a lot of comments on the calls from a lot of these industrial stocks is very favorable. And so I think you can own those regardless of who's in the White House. So that's one area that if you want to hedge your bets, this would be one place to play, is the infrastructure.
There's certain parts of the economy that really need help, right? I mean, pipelines that were put in place 2,000 years ago, they're falling apart. Things that are going to break if we don't fix them soon.
Yeah, well, you're seeing a lot of that in California, right, with all the concerns over the power lines.
Uh-huh.
And so to the extent that these severe weather events, if you're living in Florida, reinforcing the infrastructure for the power grid and updating the power grid, that's a really key area. So yeah, there's a big demand for it. And if you go through the American Society of Civil Engineers, ASME, they talk a lot about, they do what's known as the report card on the nation's infrastructure. Now, granted, they've got some incentive to say that things are bad, because that's how they get their funding.
Yeah, sure.
So there's always things to be worked on. But suffice it to say that you do have a lot of old bridges out there. There's a lot of bridges in the country, and a lot of them are old. And so the roads and bridges, repaving, there's plenty to be done with just the traditional infrastructure. There's plenty to be done in that 5G arena, which could help productivity. And then, as you mentioned, for things like power lines and the transmission grid, updating all of those. So there's plenty of things you can work on. And all the work that I've done in the past, there is a big payoff for that in terms of increasing the productivity of your economy. That's something that China was really good at doing, was updating their infrastructure in terms of their ports and airports and roads and bridges. And so there's real benefits to that. And when you have a 10-year treasury that's trading below 1%, money's really cheap. And so that's an area where you can get a lot of bang for your buck, especially with these really low interest rates. And you can fund it with long-term debt that's historically cheap right now.
Well, I wanted to ask that. This is probably a really very stupid question, but I'm thinking, where is all this money going to come from? And here you're saying, well, there's low interest loans and things like that, but it seems as though we're kind of at a standstill, aren't we? Don't we have to get the economy back up and the people back to work and everything else before any of this can happen?
Yeah, well, when you do all this fiscal spending, it boosts economic activity. And so if you look, so we had that massive snapback in the third quarter, north of 30% GDP growth in the third quarter. So we had the collapse in the second quarter because of the lockdowns, and we had a big snapback in the third quarter. But we're still 3.5% below where we were last year at this time in terms of our economic activity.
Right.
So we still have a long way to go to get out of this hole that we dug ourselves because of the pandemic and the lockdowns. And so fiscal spending is the way that you accomplish that. So when the private sector is contracting or not doing well, you spend a lot of government money to make up for that deficit on the private side. And so that's why all this talk about a follow-on stimulus package is really important, because we still have that, even though we spent north of $2 trillion back in March with the CARES Act.
Close to 3.
Yeah. So that big hole that we filled with all that money, and it's still, some of that's still being used. There's still a deficit there that we need to address, and especially some of these areas that were hardest hit by the pandemic.
Yeah.
And so when you have these really low interest rates, it's the time to take advantage of them. And the concern would be that if you don't fill that hole, then your economy runs the potential of stagnating, and you can see confidence deteriorate both on the business side and the consumer side. And so you don't want to see that happen. So far, ever since we've opened up the economy, you're seeing confidence return. And so we want to see that continue to return. And so to the extent that the market's doing well, so the stock market doing well, businesses making profits, that restores confidence. And then all of a sudden you could have a self-sustaining recovery. We think we're on that path, and we think we need one more package. And we think we're going to get that too, because you've got the majority of the American public, both Republicans and Democrats, they're in favor of that $2 trillion that was a coronavirus stimulus package, a follow-on package on the order of about $2 trillion. So you got the American people that want it. We think it'll ultimately happen. It may not happen until after the election. Actually, that's probably the highest probability after the inauguration. But just one last piece of fiscal stimulus for the economy to get us through this. We think it's needed in a lot of ways.
Yeah, so we have someone on this call who's an expert in modern monetary theory, and he keeps sending me emails telling me I don't understand it. And there he is. That's the guy. I think I sort of get it, but I think the underpinnings are this print money, and it will stimulate the economy and it will cause growth, so that will cover the bill. But I guess I'm disturbed by that, because how much growth does it take to cover that bill? Plus, I think the way it gets paid is with taxes. So some of the underpinnings of modern monetary theory, to me, say probably not paid in this generation, maybe not the next generation, maybe not the generation after that. Somebody's going to pay the bill, but I feel like we're sitting back here going, it's not my problem. It's my kids' problem.
Yeah, so, at some point you would like to see us on a path to sustainable budgets, which we aren't right now. If you look at all the CBO projections.
No, $7 trillion now in a $20 trillion economy, heading towards $10 trillion. So it's not a small number.
Yeah, and so that's a big part of this election. So if you were to see a blue wave to where they get major control of the Senate, you'll see a lot of this spending. So Biden, in terms of stimulus packages, you've seen the House of Representatives, the Democrats, in October, they passed a stimulus package on the order of $2.2 trillion. And you saw the Senate, the Republicans, pass a package on the order of $500 billion. Mm-hmm. And so there's a big difference, discrepancy between the two of them. And so to the extent that you have a blue wave, you'll see something a lot closer to that $2.2 trillion.
Yes, I agree.
If the Republicans hold the Senate, you'll see something a lot closer to that 500, or the potential of something a lot closer to that 500 billion. And then it becomes a question, if Trump wins and the Republicans hold the Senate, you're probably going to get something closer to that too, because he had been willing to go north of 1.5 trillion. So odds are you'll probably see something a lot closer if Trump wins and the Republicans.
It's a lot of money. It's a lot of money. One of my friends actually just wrote something about the ways to address this spending, and one of the things on the list is done. It's don't pay interest.
Is that Larry?
Yeah, it's Larry.
Yeah. I get the question all the time, and the example I'll give you is Japan. Japan, their real estate and stock market bubble collapsed in about 1990,
Hmm.
And so here we are 30 years later, and they're still fighting deflation, and they have zero interest rates, and their
Yep,
balance sheet, their government balance sheet is much worse than the United States.
it
So,
is. Yep.
and so to the extent you have excess savings in the system right now, with a lot of baby boomers, there's a lot of people tell you there's a lot of excess savings that can keep interest rates low right now. And so to the extent that you don't have that pressure, um, this could go on for a while. And I know there's people out there that are concerned about inflation heating up, but
Sure.
ever since the global financial crisis, we've been fighting a deflation battle, and until proven otherwise, that's the Fed's number one concern.
Yeah,
And
that's comforting. Yeah.
they're,
But
they're, they're telling
we'll
you that
see.
loud and clear
Yeah.
right now.
Yeah. We'll see.
Well,
I'm sorry. Can we go on with the list?
yeah. Wait, I want to ask a question here, and it's probably very stupid, but
Don't
again,
don't
keep
do that. They're never
okay.
stupid. They're good questions, Kat.
Okay. The reason I say this, Mike, is because I'm the baby boomer that doesn't know a thing about financing or financial issues or whatever. I'm the one that is in the back looking out saying, what am I going to do to make money as a senior? Because I didn't have the nest egg that I should have had. So I'm one of those. So a lot of the people I associate with, they've lost their business now because of COVID. They weren't sustainable enough to be able to last that 6, 8, 10 months. And they're out of business now, and they're sitting back and they're saying, I don't know what to do now. They're
It's
not
hard.
getting
Really hard.
the stimulus package just isn't enough. The CARES Act just isn't enough to help them to get them back on their feet. Is there anything that Biden or Trump is saying that they are going to help with those people that did go under?
Well, they've done a lot to try and help small business. So if you look at
Yeah.
the original CARES Act, a lot of that money was directed towards small businesses. So
Hmm.
the paycheck protection program, and the Federal Reserve rate some of these loan arrangements to help small businesses, and any follow-on package would try to help them also. So uh,
Is there a follow-up package that does really address that, or is it, I'm just not familiar with it, so I need input.
yeah, well, any small business should talk to their local banker. So
Good luck.
Good loan program. Yeah.
Good luck.
Yeah.
You can't get in to see anybody at the bank because of COVID, and if you do you can talk to them on the phone. That's about it.
yeah, they've given a tremendous amount of money out in a tremendous amount of loans. So that help has been out there.
Hmm.
I would just recommend if they've been working with a banker, they should work with them or find one, because
Yeah.
the banks have really been incentivized through these the paycheck protection program.
Hmm.
I wrote one paper on it, but I tell people that they've got to talk to their banker.
Yeah.
But
Makes sense.
there's been a lot of money that's been given out to
A lot.
business.
Yeah. And the abuses are there too. Just where you throw money at stuff, you're going to find abuses, and that's unavoidable.
Right. Right. I get that.
Yeah,
Okay.
it to me, it's been really, really impressive how a lot of these loans have been able to be distributed.
And yeah.
The speed with which we were able to react to this. I mean, the CARES Act, even that original plan that it was north of 2.2 trillion for the CARES Act itself, the speed with which they did that, and the speed with which
Yeah.
our Federal Reserve flooded the system, and the programs that the Federal Reserve did for backstopping the corporate bond market. So they stated that they would buy corporate bonds, which they had never done before, including high yield or junk bonds. And so that created massive amounts of liquidity for business. And so between the CARES Act, giving stimulus checks and the extra unemployment insurance to keep the consumer whole, and then all the liquidity provided to the banking system directly through the Federal Reserve, and then through corporate America through backstopping loans that they would issue, that was night and day compared to the response to the great financial crisis of a decade ago. So it's really the speed of this thing and the magnitude of the response has been extremely impressive. And this thing could have been a lot worse without that response. But those banks, you'd have to talk to the right banker. But there's been a lot of help that's been applied to the system.
Yeah.
Which is a lot different than what we faced in 2008. the response was really delayed and muted, and people felt
Nobody knew what to do in 2008. I think it was just this dilemma that. So the solution to overspending was to really spend. Let's stimulate the economy with more spending, and it worked.
Yeah,
It seems to have worked. Because the gears were locked. I think that was the problem.
Yeah. In '08, we had a frozen banking system, and we had a consumer who was drowning in debt. And heading into this, we had just the opposite. We had a banking system that was in tremendous shape because they had been improving their balance sheet for a decade, and they had the regulators making sure that they had a lot of capital on their balance sheet. And then the consumer had been paying down their debt load ever since the great financial crisis.
Yeah.
You had a healthy banking system, healthy consumer heading into this. Unemployment was at 3.5%. So all those things, and you didn't have a lot of imbalances in the economy. There weren't many bubbles, if you will, or major imbalances. So all this is helping us recover from this. And so the people that right now are looking for a job or lost their employment situation, you're actually seeing a record rate of business applications right now. So applications for new businesses is spiking, and that started to take off.
That's good.
So you're seeing a lot of new business formations taking place.
Good.
And every metric we look at is showing that things are moving in the right direction. And so we think if we get another package, independent of who's in the White House, we think we're going to power our way through this. And you're already seeing that. I mean, you're seeing optimism return. You're seeing the unemployment rate plummet.
Mm-hmm.
So
it's happening.
Yeah.
Okay. Do we want to go on with this?
Yeah.
To the financial area?
So we talk about the financial. So, is the financials. So under Obama, there was a lot of heavy regulation on the financials. And so Trump, his deregulation program, which was massive, nobody deregulated more than Trump did. And he was able to do a lot of that just with the stroke of a pen through executive orders. He had a policy. You had to cut 2 regulations for every one that you wanted to add. And you saw that show up in the data in terms of optimism, business optimism, and business executive, CEO, CFO optimism. That spiked as a result of a lot of this deregulation. And so the financials were big beneficiaries of Trump's, the tax cuts that he put through, getting the corporate tax rate down to 21%. So a lot of these financials, they operate specifically here in the U.S., so regional banks and things like that, that lower tax rate was a big benefit to them. Anybody who has the majority of their operations here in the U.S. And then just the reduced regulatory burden on the financials, that was a big benefit for them under Trump. And so to the extent that the Democrats win, you'll see increased regulation on the banks, and that they would be hurt by the higher tax rate. Their profitability would be hurt. One caveat that would offset that is that what you're seeing, the 10-year bond rate right now is moving up. And so you're looking at a lot of these market indicators that are pointing to a Biden victory. Earlier, I mentioned the TAN, the solar ETF. You're seeing the 10-year treasury now drifting higher. Even with the market volatility, the way it's picked up recently, and the way the COVID cases have picked up both here in the U.S. and even more so over in Europe, you're seeing the 10-year drift up. And we think what that's telling you is that it's baking in that Biden win and all the increased fiscal spending that the Democrats will do. So these financials have really been hurt by not only the zero interest rates on the short end, but the really low long-term rates. So the financials, they borrow at the short end of the curve, so they're borrowing at zero, and then they lend at longer-term interest rates. And so that differential is really important to them. It shows up in their net interest margin profitability. And so to the extent that the 10-year drifts up, that's a positive for the financials. That's something that we're looking at to move overweight on the financials is a higher 10-year treasury yield or higher long-term interest rates. And so you've got some offsetting factors on the financials right now. So if Biden were to win, the increased regulation and the higher taxes would hurt. But if you had long-term interest rates creeping up a little bit, that's beneficial for them.
Interesting. Okay.
What about healthcare here?
Yeah. So if you look at healthcare, they both support price controls, drug price controls. but we think you have a more likely event of that occurring under the Democrats. So the better the Democrats do, we think you would have a more likelihood of drug price controls being put into place. And so that's that would impact negatively the pharmaceuticals and biotech. And then if there was a Republican sweep, that's not what that's not what the market is saying is a high probability thing.
Yeah.
But if that were to occur, you could have a further attack on the Affordable Care Act. I'm sure everybody remembers back when Trump first got elected, they spent almost a year trying to repeal the Affordable Care Act before they did tax reform. So they didn't do tax reform until the end of 2017, and they spent a big chunk of early in his administration with the Affordable Care Act. So that's something that's potentially in play if you did have the Republican sweep, and so that would be negative for the hospitals and Medicaid HMOs.
Has anyone seen the Republican replacement for the Affordable Care Act? I know Trump has been challenged by it. He says there is a plan.
Yeah.
But I just wonder if the plan is more in development than a reality.
Yeah, I think it'd probably be more development.
That's what I thought too. Yeah, I'll just throw something out here from a personal thing. I needed to get this drug that by the formulary under my insurance, it was still very expensive. So my doctor suggests that I visit Global RX, and I'll even tell you the numbers. The drug is $340 with my copay, and Global RX was $50. So I guess you take the risk when you go on these websites, but part of the point is that I think we're paying a premium here in the United States that you can go outside this country and find the same drug. And I guess you take the risk that the quote same drug might not really be, but I think that's the reality, at least in this case of this one drug that I needed to do.
Yeah. One thing you just want to make sure you don't do is take away the incentive to come up with new drugs.
Oh, sure.
So there's a fine line that you're walking in, and you're seeing this right now with all these major pharmaceuticals and biotechs. They're working on these vaccines and therapeutics in record time, and it's been extremely impressive to anybody that's paying attention to it, how efficient and how good these companies are at what they do, and it's the profit incentive that motivates these guys, and so there's a fine line between crushing the profitability. And,
I guess this is the flip side of that. Is I've seen charts that show the quality of medicine plotted against the cost of medicine, and the United States is far below sort of a trend line. We're paying a lot of money for not much quality of healthcare. It's a very expensive country to live in for healthcare.
Yeah, we subsidize the rest of the world.
I think so. Yeah, well, that's simple enough. That's the good answer. It really is.
Yeah, and so one other thing is that government-run public health insurance option that Biden has spoke of and is part of his platform. That would be a potential problem for the health insurers, and so. Right now, most people are happy with the private insurance. So you got about 180 million people that like having private health insurance. And so to the extent that you would potentially undermine that private insurance option, that could be a big game changer for the healthcare industry longer term.
Yeah.
So essentially getting rid of the middleman on that.
Mm-hmm.
Okay, and the last is technology.
Yeah, so we think tech, while they're both pursuing antitrust probes, or while they would both want to pursue that, we think tech would fare a little bit better under Trump. We just think that they're going to face more regulation and potential for that under the Democrats. And then I talked earlier about the higher taxes that Biden wants to put on international profitability. So a lot of these tech firms, they do things internationally. The majority of the technology sector's earnings comes from overseas. And so to the extent that they've been able to shield some of those earnings from U.S. taxes, Biden is going to pursue that. He's looking to double taxes on some of those international profits. And so we think the tech is a better beneficiary under Trump than under Biden.
Got it. This is interesting stuff. Very, very, very nice, Mike. Good
Oh,
work.
you're welcome.
And you've written quite a bit. You want to talk about the things you've gotten? And I think we have them links on the website, Kath?
Yeah, well, there's actually a couple more. So if you look at defense, we didn't cover much on defense, but defense was a big beneficiary under Trump. And so to the extent that that the Democrats would win the White House and their potential to win the Senate and hold the House, they would probably at a minimum grow defense more slowly. So defense is if you're looking to make a bet on one industry versus another, defense is we think favors more favorably under Trump. And then under trade, we think that trade enforcement actions on China are going to continue regardless of who's in the White House. But we think you're more likely to see major efforts to restructure trade with China under Trump. And so Trump, he would look to negotiate bilateral free trade agreements with the UK, the EU, and some other countries. Whereas under Biden, you would probably see more of a partnership with our allies against China. So we don't think this trade conflict with China is going away by any stretch, but we think that it would be a little bit more. There'd be more trade tension under Trump, and that under Biden, you'd probably see a partnership with our allies because there's a lot of other major, like the Europeans, they've been hurt through certain trade practices that I'm sure that they would be more than willing to help out with a partnership on that trade front.
Okay. Have the Chinese really taken that much advantage of us? I seriously don't know the details, but I do know in the Great Depression, the Smoot-Hawley Tariff Act is sort of blamed for extending the length of the Depression and the depth of the Depression, sort of suggesting that you need to be careful with tariffs at a minimum.
Yeah, well, you could really see it show up in the trade data. So we spend a lot of time looking at business surveys, and trade tensions. They definitely show up in the data. And so, if you're a CEO that's making a business decision and you're concerned about trade, odds are you're just going to wait it out, and so that hurts economic activity. And so, anything we can do to reduce trade tensions, we think is favorable. But when you look at long-term technology transfer issues with the Chinese, I think a lot of those are real, and I think the Europeans share a lot of those concerns. And you can look at business surveys on those things. So they share a lot of our concerns about those technology transfer and patent protection and having to form partnerships in order to do things over there. Those are concerns that we have and the Europeans have. China, so.
Okay. So, Mike, you want to talk about some of the articles that we've made available so people could want to learn more, could read more?
Yeah. So anybody that's interested, we've got the paper out there on the presidential candidate investment implications. That basically highlights the major differences between both candidates, and we discussed a lot of those issues. But then there's also background information. I've written special reports all year long because these issues are so important with the election. Things like infrastructure investing, so 5G, special report on 5G. You've seen a lot of commercials being run for the upgraded networks, and guys like Apple, they're putting out their new 5G phones, and so a lot of interest around that whole 5G.
That's a big deal. 5G is a big deal.
Yeah, and so it was actually fun writing that paper. I enjoyed it, but I think that's going to be more. I mentioned in it that it's evolutionary, not revolutionary, because it just takes time for people for the networks to be built out to handle 5G, and then adoption from customers and in factories. So you'll see it show up like within a factory itself before it would be connected on a more national basis or international basis. So you'll see a lot of factories that are utilizing that technology within themselves. And then you'll see 5G. You're seeing 5G show up in the big cities, so places like New York, Chicago, LA. Those networks will show up there first before it gets built out as part of a national grid. And so the adoption and how the infrastructure gets built out is going to play out over time. But it's really exciting. And so, if you go back 20 years, I mean, we just started using cell phones 20 years ago.
Yeah.
And,
Some of the old movies with the first cell phones are a hoot. It's like carrying a football on your head.
Yeah. And so look at today. I mean, that little device in your hand has as much power or more power than what it took to get somebody up onto the moon. So
yeah.
And so all those things, all those advances
Amazing.
will continue to occur.
Yeah.
But we think it's evolutionary. We don't think it's like a big bang that's going to take place on this kind of a thing.
Cool.
But yeah, so that's interesting. And then this investment themes for the next decade, as a result of the pandemic, we saw a lot of things get pulled forward, and so you saw a lot of software work. You saw guys like Peloton and Zoom and all these technology companies really thrive in this pandemic environment.
Sure.
And so, but in a lot of what you just saw things get accelerated. So changes were accelerated, and communications technology drove a lot of that. And so this paper really speaks to how important technology is. So whether you're within the tech sector itself, I mentioned the software names, I mentioned the semiconductor names. So that's the tech names themselves. But every other sector, if you look at what's driving the sector, it's the guys that are utilizing this technology best. So if you look within the industrial space, the companies that are thriving the best there are the ones that are able to take advantage of big data, the speed, take advantage of cloud computing, and artificial intelligence. So all these areas, so big data, cloud computing, artificial intelligence, and just being able to marry all those concepts, the companies that can do that. So whether it's Amazon and consumer discretionary, or a Honeywell or Rockwell International within industrials, or even the best in class healthcare names, they're taking advantage of artificial intelligence and big data. Guys like Johnson and Johnson, or a lot of these drug research firms, and you can go across the board. Even the best energy companies that are out there are taking advantage of big data and artificial intelligence. I mentioned how they're running wells remotely and collecting data from all the different wells to optimize their operations. So technologies, that piece just emphasizes how technology is at the heart of pretty much every well-run company that you want to invest in. So, and a lot of those things are just pulled forward by the pandemic.
Great.
And then so infrastructure. Both presidential candidates want to work on infrastructure, and I mentioned how infrastructure, a well-constructed infrastructure or a modern infrastructure, that's key to productivity, or it's one of the keys for productivity. And so there's a big demand for it. And to the extent that you have these historically low interest rates, you can get the cheap financing for it. So I mentioned how fiscal spending can fill in that gap that the private sector, the deficit that we have in the private sector on the economy right now. So there's a lot of reasons why you would think infrastructure would be a good thing to do. The low interest rates, the need for it, the way it increases productivity, and the hole that we have in the economy right now as a result of the pandemic. So all these things combined together make it something that is a relatively easy sell for the public and for politicians.
Great.
Yeah, and so we've mentioned some of the parts of the CARES Act, but it was extremely impressive how rapid that the government was able to act when they had to. Sure, everybody remembers the market sold off 34% from the high in February to the low in late March.
1 month, yeah.
And then as soon as this plan came out, you saw the market just flip on a dime, and it hasn't looked back since then. And so a lot of this was providing money for consumers. So I mentioned the stimulus checks, the increased unemployment, the $600 a week increase in unemployment insurance. But it also, a major part of that was the Paycheck Protection Program. So the PPP, which you gave money to small businesses, and if they used 60% for employee wages, they would be known as grants and not loans. And so there was a lot of money that was put into the system to hold things together. And there are a lot of other programs in there, including the Federal Reserve. I mentioned some of the things that they did, but all of this combined was tremendous in holding the system together when we went through the lockdown, which was a unprecedented historic collapse in economic activity as a result of it.
Yeah.
And the snapback we had, you can really attribute it to the speed of this response and the magnitude of it was extremely impressive. And so that's why we think we're going to work through this regardless of who's in the White House. So, we hear people wanting to go to cash as a result of the election or heading into the election. And
A little soon.
yeah, we're not in favor of that. We think we're going to be
Yeah.
okay regardless who's in the White House. And even if Biden does get in, the market's done well under Democrats in the past. It's done very well. I mean, the market did well under Obama. It did well under Clinton back in the 90s. And so we don't think people should be overly afraid of the election outcome.
Good.
Oh,
So-
and climate change. Yeah, climate change. This is a good one. So for anybody, this is
A lot of stuff. Thank you for sharing this all with us.
Yeah, so this climate change piece, I wrote that in January. I actually presented that to the Pittsburgh CFA Society. And there's a lot of, for some reason, this is very political, but if you look at within the scientific community, there's no longer a debate in the scientific community. So that Intergovernmental Panel on Climate Change, the IPCC, they every 5-6 years, they come out with a new report on what they're seeing from all the data that they collect and all their math models that they run on climate. And they've gone from, we think it could be an issue to today, there's no debate with them. And this is on a global basis. This isn't just here in the United States. This is the Europeans, the Japanese, the Chinese, the major universities within all of these different regions of the world. So the scientific debate, there's really not a debate in the scientific community. And so that's translating into a majority in the public. So if you go back 5 years, you had the minority of the people in the United States think that climate change was a problem. Today, fast forward to today, you've got the majority of people that say that it is real and it's happening. And it's even more so internationally. So you've got a much greater consensus among the public internationally. There's the debate in the scientific community has been put to bed, and now it's translating into a consensus in the general public. And so we think that this issue isn't going away. The one key way to play it is through ESG investing, so environmental, social, and governance investing. That's a really hot area of investing that's taking off. And you're seeing a lot of pressure on these energy firms, the traditional oil and gas firms. They really haven't participated in this recovery. I mentioned that they've got a lot of spare capacity issues in the system, and oil prices are low because demand's low, and there's a lot of excess supply out there. But even on top of that, you look at the terminal value of a company, which is typically the biggest chunk of value in a firm. I think that's probably being discounted because of these climate change issues. So I think it behooves all investors to pay attention to what's going on with this whole climate change issue, because it's a subject that's not going to go away.
Yep.
Okay, well, that's good. That's good.
Yeah, thanks. Thank you.
Oh, you're
Okay.
welcome.
So I think that's the end of our show. Is there any last comments that you guys want to make?
Mike?
I just think people should stay the course with their investment plan and don't get too nervous about the election results. And even if there is a delay in the results, we saw that back in 2000, whenever the Supreme Court finally was going to make a decision on it, and Al Gore conceded the election to Bush. So the market hates uncertainty. It's sold off in that time frame, but it'll rebound shortly after the uncertainty is lifted. So even if it's a delayed election because of the mail-in ballots, we think people should hang in there. We see this economic recovery continuing, and we're going to be okay.
Well, congrats, Mike. Carrie just gave you a nice compliment, so you did a great job.
Oh, thank you.
You both did. You both did.
So one thing I want to do, Kath, that we do on every show is we started this thing in February, largely because the data is saying that our fellow baby boomers are, in our opinion anyway, forgetting that their number one objective at this stage in their life should be to protect their savings, because that's all there is. So we hope we're doing a public service here by encouraging you to get in touch with that, talk to your advisor, make sure that you are taking the risk that you want to take, because this 60-40 rule is so entrenched in the business. 60% equities, 40% bonds. And it might be right for you, but it seems to be what the typical baby boomer is investing in. And then the last thing I'm going to say is our next show is in 2 weeks, and we're going to talk about the aftermath of the election. So we'll know a lot more in 2 weeks.
Oh, that sounds great.
Yeah,
That sounds great.
is.
Yeah. Yeah. Well, either way, one way or the other, all of this chaos that's going on hopefully will be over. So we'll know one way or the
not
other.
going to be over.
Yeah, it's not going to be over. Okay.
Not
All
in
right.
2 weeks.
Then color me wrong.
Yeah, but we'll
Okay.
have something to talk about. That's for sure.
All right. Well, thanks everyone for watching,
you.
and we will see you next week. Okay. Bye.
Thanks, guys.
Bye.
Bye.